Welcome, ladies and gentlemen, to the Cima Strategic Case Study Financial Strategy or F3 Essentials Refresher, Segment 5. In fact, my personal favorite. Let's have a look. But before that, what do we need to do? Please have a notebook and pen on the ready. Do follow the slides and my explanations very carefully. Take notes. Maintain a list of doubts or clarifications. Maintain a list of key topics that you feel you're weak at, so you can self-revise either using the pause button immediately or later, and make sure that you stay focused. So even if it helps to take periodic breaks every 15 minutes, every 20 minutes, by all means, please do, but make sure that you use the most effective and most suitable way for you to absorb this content. So, a quick reminder on the core activity. Recommend financing strategies, and we have in detail looked at the first two areas: evaluate suitability of sources of finance and recommend dividend policy. But we are yet to look at business valuation, and this is exactly that segment. Recommend and apply business valuation models. So this segment is dedicated to learning about all the methods that are available for us to value a business and anything and every single consideration associated to that within the Cima F3 content. All right, business valuation. It's a very interesting area, and there are different methods of valuation, and you're basically quickly seeing a snap of various words, right? The net realizable method, PE method, dividend valuation method, replacement cost, book values. All of these are different methods of valuing a business. In addition to that, actively you can value a business looking at discounted cash flow techniques and applying it to future free cash flows. So this is basically a quick snap of business valuation, but it's really more interesting than that snap alone. The beauty of business valuation is that it is not a precise or scientific process. It's not an exact science, right? There can always be a challenging value to a business. The value of a business is affected by numerous reasons or numerous factors, like reported sales, profits and asset values, forecast sales, profits and asset values, type of industry, level of competition, range of products sold, breadth of customer base, perspective of the buyer and the seller, who will often have different expectations and hence may value the business differently. So it's really not very different to negotiating one of the assets that you own, or especially if the asset has been built by your own hands. Business valuation methods can only suggest values of a business. The final value is then agreed between the buyer and seller after a process of negotiation. This is pretty much what happens in valuation, right? You use the different theoretical valuation techniques. You hire big four companies, or you hire consultants to go through all the numbers, and they do the entire due diligence work, and they get all this information, they value, they apply all these different techniques, they get a range of values, and that's all you can do. The deal might happen at a value that is not even any of the single values that were derived. So you're only using the techniques to get an idea, to get a read on different ways. And the problem with business valuation is that different techniques can give completely highly different values, and that can also increase the ambiguity around creating a deal, right? This is why a listing, right, stock market listings have become so popular, because the capital markets are one place, especially for a quoted company, that gives gives certainty to a value of a business. So fundamentally, there are three main ways of valuing a business, and this is number one: asset-based valuation method. The business's assets form the basis for the valuation. Asset-based valuation methods are difficult to apply to businesses with high levels of intangible assets, right? Because you are really looking at the tangible aspect of the business. The company is viewed as being worth the sum of the value of its assets, total assets net of liabilities. Most useful when a company is being broken up rather than purchased as a going concern. And the method does not incorporate the valuation of intangible assets. It usually gives a low valuation figure which helps the parties to set a minimum price in a takeover situation. So the asset based valuation method is really something that provides us a baseline in terms of the minimum value, likely to be more useful for capital intensive businesses than for service businesses where many of the assets are intangible. And the asset valuation can be calculated in various ways. Obviously, you have the book value, original costs, and a function of depreciation policy. Replacement value, right, which is the cost of replacing those assets today, right? You're really looking at market value then. Breakup value or net realizable value, or what for assets, general assets, we call it scrap value, right? Best price on the second hand market. What are the strengths and weaknesses of the asset based valuation method? Strengths: the valuations are fairly and readily available, they provide a minimum value of the entity. But weaknesses: the future profitability expectations are ignored. That is why we noted that this might not be the best method to value a business that you're looking to purchase as a going concern. And the SOFP valuations depend on accounting conventions, could lead to valuations that are very different from market valuations and market perceptions. The numbers could have been cooked or manipulated. That can have cause further problems, right? These are some of the weaknesses that we notice, and it's difficult to allow for the value of intangible assets. So we continuously saw this weakness in asset based valuation where intangibles are being ignored. We need a solution. Before we look at the solution, what exactly are intangible assets? They lack physical properties and represent legal rights or competitive advantages developed or acquired by an owner. So whichever pre-scene that you get, do look at the kind of capital intensivity of that business, right? Do they have a lot of intangibles? And it can have certain implications. Characteristics: they are the identifiability in terms of license, contract, document list. There's definitely some sort of identifiability. The manner of acquisition: you can either purchase or develop, right? So you're looking at whether this company purchased the rights to this intangible asset or developed it themselves, right? The determinate or indeterminate life of the intangible asset has to be considered. And the transferability, right? Can the intangible asset be transferred in terms of the rights of really just reaping the economic benefits? Let's look at some examples, right? What examples do we have for intangible assets? Intellectual property, trademarks, patents, copyrights, goodwill, equities, usage, sales and distribution rights, digital assets like cryptocurrency and domain names, right? And brands. And for each of them, I would suggest you think of an example, right? And that will register in your mind very easily. Then, how do we value intangible assets? There are simple and three basic ways. One is obviously the market approach. Here, the intangible asset is valued by comparing the asset to an identical or very similar one that has recently been traded in an arm's length transaction. So you're using a different transaction and using it as a sort of reliable baseline to say, okay, that happened at that price, so this also can happen at roughly maybe a price around that deal. Two is the cost approach. For some intangibles, like internally developed software, example websites or applications, a cost approach to valuation can be used. Historic cost could be easy to identify, but in most cases, replacement cost or the cost of a similar new asset is the most direct and meaningful cost approach to estimating the value of an asset, right? So you're looking at it from a cost perspective that it took to build that asset. And finally, the income approach. Income based models are best used when the intangible asset is income producing or when it allows an asset to generate cash flow. You convert the future benefits such as cash flows or earnings to a single discounted amount, usually as a result of increased turnover or cost savings. So even, for example, if you were to implement an process automation system, right, which can be in the form of an intangible asset, one way you can look at it is that the moment you do automation, when the moment execution goes right, there are sales benefits and there are definitely cost benefits also. So you convert them into a certain quantified number and discount it into today's value. There you have rough estimation of what is the value of this intangible asset. Second one, the earnings based valuation method. So first we looked at asset based valuation method. This is the second one, earnings based valuation method. The projected earnings for a business will give an indication of the value of that business, right? The projected earnings, say, tell us, like, for example, if you're looking at a human being and you want to sort of kind of figure out whether this human being is a high potential or low potential, what you would really look at is that you're trying to understand in the future to what extent does that person has aspirations of continuously working. And this is something that you look at in terms of interviews, especially at senior positions. You look at the track record, but also you speak to that person and figure out the projected contribution over the next few years, and that will give you a general gauge of the value. And that is the sort of idea that you can apply here as well. So for example, a business with high forecast earnings will be attractive to a potential purchaser and hence will be valued highly. In this chapter, we shall see how earnings can be used in business valuation. The earnings of the business are forecasted and then an earnings multiple is applied. Right? So you forecast the earnings and you apply an earnings multiple that is historically derived. This earnings multiple could simply be a number negotiated between the buyer and seller. So if you determine that your earnings are 1 million per annum, and then you say, okay, fine, I need 15 times of this, I need 20 times of this, right? It's something based on discussion between the buyer and the seller. But the most commonly used approach is to take a suitable PE ratio as the earnings multiple. So suitable meaning if it's a listed company, you might look at the price to earnings multiple historically and looking at, not to say that you're going to use the previous year's figure, but you look at the momentum and the range and the volatility of the price to earnings multiple, and you make a judgment call saying I need this multiple of my earnings. So value of a company's equity is total post-tax earnings into the PE ratio. The value per share is EPS into PE ratio. This is what the earnings based valuation method entails, and this is something I'm fond of because of the straightforward nature. Now, what do you do to a company without multiple, right? There are definitely solutions in terms of proxy. Let's take a look at how it works. It relies on just two figures, the price to earnings multiple and the post-tax earnings. The current post-tax earnings or EPS for a company can easily be found by looking at the most recent published accounts. Whereas the PE ratio for a listed company is a simple measure of the company's share price divided by its earnings per share. Now, so that's basically MPS divided by EPS, market price per share divided by earnings per share, for which you need a market price. That is why I mentioned that it has to be, if it's a listed company, it's very easy because the market price is readily available. But when unlisted, an industry average PE or one for a similar company will be used as a proxy. Now, what are the strengths and weaknesses of this technique? It's simple, it's commonly used, it's easily understood, and it's relevant for valuing a controlling interest in an entity, right? Whereas weaknesses, it's based on accounting profits rather than cash flows. It's difficult to identify a suitable price to earnings multiple, especially when it's not listed. And it's difficult to establish the relevant level of sustainable earnings. Right? Because anyway, if it's a method of projecting future cash flows and you have a sort of projection today, you never know if that will materialize. You never know to what extent that your projections could be accurate. These are all future, and the future is, we live in a day and age where future is most uncertain, right? And that brings me to the third and very interesting method of business valuation, the cash flow based methods, which again we look at a couple of variations with respect to cash flow based valuations. The first one is the DVM or the dividend valuation model. In theory, a business's value should be equal to the present value of its future cash flows discounted at an appropriate cost of capital. But when you're looking at it from a shareholder's perspective, you can consider dividends to be one of those indicators. The theory states that the value of the company or share is the present value of the expected future dividends, discounted at the shareholder's required rate of return. So if a shareholder wants to value a business, the shareholder is thinking, what are the returns am I going to make? And the answer to that is dividends. Okay, fine. If I'm going to make dividends, and if I want to really understand how much the value of the total business is, what are the dividends, what are the projected dividends over the next whatever number of years, you get a cumulative present value of that figure and call that the value of the business. If we assume that all cash flows to equity are paid out as dividends, the DVM would therefore give the same result as valuing a company by discounting cash flows to equity at the cost of equity. Right? That is assuming that all the money you make, all the cash flows to equity are paid out as dividends. So you're really not doing anything different. You're either discounting the dividend or discounting the cash flows to equity at the cost of equity. So here we go, right? It's the simple annuity or the perpetuity valuation equation that is being used. PO, which is the value of the company, is DO, total dividends divided by the cost of equity. Or if there's a constant growth expected, you consider the dividend per share or the dividend of the company into 1 plus G, which takes account the growth, which means you're using the next year's figure, divided by the cost of equity net of the growth rate. So because you have counted a G, you're discounting that G from your denominator. Right? That is the formula, but as far as DVM is concerned, you have to have a good understanding of the overriding logic behind it. It's that simply the value of a company is the present value of the expected future dividends discounted at the shareholder's required rate of return. Let's take a look at the strengths. This has a sound theoretical basis, useful for valuing minority shareholdings where the shareholder only receives dividends from the entity, obviously because you're only valuing the dividends. Weaknesses, very difficult to forecast dividends and dividend growth, especially in perpetuity, especially forever, because you want to assume that the company will be paying out dividends, and that is not a really practical game to play. Particularly for unlisted companies, it can be difficult to estimate the cost of equity as well. Right? You can't, you might find it difficult to even use the CAPM model because of this nature of unlisted companies, right? Where the information is not very relatively available in comparison to others also. And it cannot be used directly when the annual growth rate is expected to change. Right? That is cash flow based method part 1 or approach 1, dividend valuation model. Approach 2 is discounting your free cash flows, right? Discounting the FCFs. Now this approach is it's very detailed, right, to say the least. A value for the equity of the entity is derived by estimating the future annual after-tax cash flows of the entity and discounting these cash flows at an appropriate cost of capital. Now, I want to take your attention to one word here. A value for the equity of the entity, right? Not the value of the entire entity, but the value of the equity of the entity is derived by estimating the future annual after-tax cash flows and discounting them at an appropriate cost of capital. Why? The discounted value of future cash flows represent the wealth of the shareholders. So we are trying to figure out the ownership or the value of the business of the shareholders portion, not the debt portion, but the shareholders portion. Cost of capital used to discount the cash flows should reflect the systematic risk of the cash flows, right? Not the specific, not the unsystematic risk, but the systematic risk of the cash flows. Free cash flow, FCF, that you see here, is the cash generated by the business that is freely available for distribution to not the lenders but the investors after having met all the immediate obligations of the business and the investment in working capital and in non-current assets that is necessary to sustain ongoing operations. So you settle all the immediate obligations, you settle the working capital requirements, you settle any based asset requirements, investments requirements that is required to sustain ongoing operations. Anything that is left after that is what is freely available for distribution to investors, and that is what we call a free cash flow. And the free cash flow is what we discount to get the valuation of the business. For business valuation, we often have to estimate cash flows using readily available accounting information. The cost of capital used must reflect the risk of the entity's cash flows. Therefore, if we were to value the equity aspect of it, what we will do is we will take the cost of equity that can be used to discount the cash flows to equity owners, that is the post-tax cash flows after interest, in order to value the equity in a company directly. So remember, if you want to value the equity portion, right, the owner's portion of the business, then you have to look at the equity owners or the money that the company owes to the equity owner, and that is cash flows after tax and after interest, because the lender's amount also has to be settled. Whatever that is left is only the equity owner's amount. Remember, the lender is in the hierarchy of recovering cash. The lender is always on top of the ordinary or the shareholders. But if you were to value the equity and debt, what you will do is you will use the WACC, the weighted average cost of capital. It can be used to discount the cash flows to all investors, that is post-tax cash flows before financing charges, when valuing a project or an entity, right? Before financing, right? So within that amount you have the debt holders commitment that the company owes, which is interest, and the equity holders commitment which the company owes, which is the net profit after interest. That is what happens here. You can basically calculate the equity value of the business, separately calculate the debt value of the business, add it, and you have the entity value. Theoretically, the equity value plus debt value, right, which is discounting the cash flows attributable to all investors, including lenders and the shareholders, should be the total of the equity value and the debt value. And generally for debt value, deriving a market value of debt is also a possible thing to do, given that you have all the information, and information is also an area that we will touch here, right? What are the strengths and weaknesses of the discounted cash flow technique? Theoretically, this is the best method. It can be used to place a maximum value on the entity. It considers the time value of money. Whereas weaknesses, it's very difficult to forecast cash flows accurately. Forecasting itself is very difficult to determine an appropriate discount rate, right? The cost of capital, are we using the right figure? That can be a challenging task. And what time period should we evaluate in detail, right? Because we use something called the terminal growth period, right? You forecast your cash flows up to maybe 10 years, if you can for 15 years. If you are using Excel, you might even go up to 20 years. But thereafter, the company, we assume that the company exists, and that, right, that terminal growth period is a important metric in the discounting formula, which is simple G. And what exactly is that G, right? How can we forecast that in 30 years down the line the growth rate will be at 5%? I mean, who the hell is anyone to certainly say a number like that, right? What do we know about what's going to happen 30 years down the line? That is that problem of consideration, problem that is considered here as far as the time period is concerned. The basic approach does not evaluate further options that may exist, and the basic approach assumes that the discount rate and tax rates are constant through the period. And this is not investment appraisal. We are not looking at a project. We are applying that same free cash flow discounting technique to value an entire business. So when you are valuing an entire business and you are using all these projections and assumptions, you never know about the certainty associated with them. So that itself is a risky aspect. Next, we will look at the beta impact. Now this is the thing, how it relates to the valuation is because of the cost of capital, right? We were talking about the cost of capital and appropriate discount rate here. So if you are valuing both the equity and debt components, what will happen is that you're trying to use the WACC, weighted average cost of capital, right? And the weighted average cost of capital is made up of cost of equity and cost of debt. And the cost of equity can be a result of the capital asset pricing model which uses beta, and that is the relationship we have to beta here. And I'm not going to spend a lot of time here, but this simple correlation between the idea that there can be a geared beta and an ungeared beta. The geared beta is usually known as the equity beta, which measures the systematic business risk and the systematic financial risk of a company's shares, right, which takes into consideration the risk associated to the financials of the company. The beta U or BU is the asset ungeared beta, measures the systematic business risk only. So here what will happen is that the debt beta, given that the entire beta formula is a weightage of the geared beta or the equity beta and the debt beta measures the risk associated with the debt finance. Usually we assume that the debt is risk free and hence the debt beta is 0. So if this becomes 0, we end up with this formula, right? And this formula gives us a direct correlation between the asset beta and the equity beta, right? So that is one aspect, one additional aspect to the beta factor that I wanted to point out here. You plug that into your overall knowledge of how beta behaves, and the idea that when it comes to beta, when it measures the systematic business risk and the systematic financial risk, you have the equity beta or the geared beta. When it only measures the systematic risk, we call it the asset beta. And that leads me to market efficiency, right? The final aspect and the important aspect when it comes to business valuation, right? How efficient is the market? The level of efficiency in the market is very important when considering the value of a business. Why do I say that? According to the EMH, efficient market hypothesis, the share price is a sum of all the known information about a company. So the share price indicates what is known by the market about the company. As such, the share price is always a fair price and a true valuation. A particular share is neither under or overvalued at any point in time, and don't think that this is what happens. It's based on the efficient market hypothesis. It's a hypothetical. This means that without additional information currently not taken into account by the share price, no investor will be able to beat the market, right? That is because the market is efficient. The only way to get higher returns would be to invest in higher risk or higher beta investments. But do things work in that way? Not exactly, because efficiency has multiple forms. The first one we will look at is the weak form of efficiency. In the weak form of market efficiency, the share price will reflect any and all information that can be discerned by past trends in share prices. So imagine that you live in a market, you live in a world where a share price, what that share price indicates is what has happened in the past, right? And that sort of a market, we call it a market with weak form of efficiency. The day traders and other investors who attempt to speculate by studying past trends and predicting future movements will be wasting their time if markets are of weak form, right? Because of this disconnect between the past trends and the future expectations. If such speculators can foresee movements, then their actions will have the effect of updating the share price. The very fact of them, say, buying shares that are going to increase in price will push up the price, right? Given that it's simple supply and demand logic. But there is also the semi-strong form of efficiency. In the semi-strong form of the EMH, the share price will reflect all information that is publicly available. Not only the past, but in addition to that, all the information that is publicly available. Analysts who study press reports, financial statements, and economic figures in order to identify mispriced shares are wasting their time if the semi-strong form of the EMH is true, because the share price is reflecting all the information. It's already reflecting, right? The share price is already reflecting all the information that is publicly available, which doesn't happen, or else, because I used to be a former analyst, and that would make my entire job invalid. Again, though, it could be possible to benefit from the ability to follow news in real time and to respond to events before they become public knowledge. And that is why I would probably, in the live sessions, we will discuss this. Even if you go to Yahoo Finance or Bloomberg, you look at a share price on real time. Every second the share price is going up and down. Why is it going up and down, right? It's driven by supply and demand. It's driven by, and supply and demand is driven by the information that is available in the market about the stock. Investors generally subscribe to information sources that give immediate access to news as soon as it is released and before it has been broadcast. And that is one reason why companies like Bloomberg, in fact, thrive, because Bloomberg terminals, right, are designed to provide real-time information about a stock that can ideally help an investor react very fast to market information, because whatever is going on in the company doesn't matter. If you are a trader of shares, you're just dealing with an asset, in this case shares, which has a value, and if the price is going up, if you can buy it at a lower price, sell it at a higher price, you're good, right? Or if you can manage it, if you can short the stock at the right time, if you can trade with the stock at the right time, you're good. Whatever happens with the company, whatever actually goes on in the company doesn't really matter. Again, their response to such news will enable the market to update itself, because a flurry of sales by major investors will signal that bad news has become available, right? So if investors are fleeing, it just automatically becomes a signal and price goes down. Then you have the strong form of efficiency. In the strong form of EMH, the share price will reflect all information, even if it has not been made publicly available. All information, even if it has not been made publicly available. Kind of weird, right? How can all information be reflected even if it's not publicly available? That may not seem credible, but information could be leaked because of, say, insider trading. So we have a little bit of illegality coming into play here. The markets may not know why blocks of shares are being purchased or sold, but the fact that someone is trading will suggest that an unknown person is in possession of some facts, and the price may respond accordingly. Insider trading is illegal, but that does not always deter perpetrators. News has become available, right? So how does this affect business valuation? So the EMH does not necessarily mean that it is wrong to pay a premium over the market price in order to acquire control of the business, right? By acquiring a share. So you're paying premium to buy a share. It's not wrong. The bidder is usually hoping to benefit from an exploitable synergy. Even so, the EMH suggests that the markets will take the possibility of a future bid into account in setting prices. That is the idea that if one person buys a share, it indicates to the, or it assumes, or the market assumes that if when one person buys, it means that another person might buy, right? That is what they say. The EMH suggests that the markets will take the possibility of a future bid into account in setting the prices. Future bid. So by looking at what is going on with the stock presently and at in the past, you determine a reasonable estimation that there could be or could not be a future bid for the share. Weak form of efficiency might suggest that patterns of past trades can be a sign of a future bid. Semi-strong efficiency suggests that any information that suggests the possibility of a bid, perhaps a loss-making company that requires the support that could only be obtained from being incorporated into a larger group, will affect the price, right? That's just an example. Strong form efficiency suggests that share prices could rise because a dishonest employee who knows about an impending bid could start to buy shares in the target company and so signal the possibility of positive news. Insider trading, right? And that is all about the efficient market hypothesis and all the forms: weak form, semi-strong and strong form, and all of these are probable, right? All of these we do witness, but the stock market is something that is highly active and highly volatile and highly dynamic and ever changing, because it's not only one type of asset, it's not only shares, it's commodities, it's options, it's all these derivative instruments that are being traded, right? It's all these rights that are being traded. So it's a very dynamic place to be in, and also for many, I'm sure, very interesting too. And that is the impact of the efficient market hypothesis and the different forms to share price and ultimately business valuation. That marks the end of segment 5 of financial strategy. Do keep working while having fun. On that note, I believe that we will see each other in another segment. Thank you.